Hello everyone and welcome back. So in this section we will be covering the valuation model of Walmart. So just a note, we like here you see on this screen we have got some assumptions. Here we have got the consolidation income statement, and the income statement is ending at EBIT. So the reason why is because if we go to the balance sheet, you will see that this company is financed by long-term debt, long-term operating lease, things like that. So the fact that the company is financed by both debt and equity, then especially long-term debt there, then we need to build a free cash flow to the firm valuation model. So a free cash flow valuation model, it only starts with EBIT. So that's why my consolidated income statement is shortened to up to EBIT there. Okay, so here I think it's time we can link through some historical information, and we also, to save time, we will be using some assumptions that I've already prepared when I tried this valuation on my own. So here let's go to the income statement. Let's link the total revenues for 2019 up to 2023. Let's also link cost of sales. So cost of sales, we link them here, and here we can easily compute gross profit. So let's do that. Then let's link operating expenses. So these are our operating expenses, and then we can easily compute our EBITDA. That's before accounting for non-cash expenses like depreciation, right? So here let's ignore this. Then let's link depreciation. So here we link our depreciation, and then we can easily compute our EBIT after we have accounted for depreciation. So here, perfect. So now we have linked our historical information, and we can also link our depreciation and amortization expense. I think let's just link it from here. Perfect. And then we can link our changes in working capital. So the changes in working capital items, we can link them from the cash flow statement. So here we can link from 2019. Perfect. And let's link inventories. We can also link that through, and let's also link prepaid expenses and other. So prepaid expenses and other, so we don't have at the moment, so we just copy that right through there. And accounts payable, so let's link accounts payable. Perfect. So the reason why we have to link prepaid expenses is because if you go to the balance sheet, you will see that there's prepaid expenses there. So we want to track every change that helps us track the true changes in working capital, right? And then accrued liabilities, let's see if we've got accrued liabilities. Yes, we do have. And also we have got accrued income taxes, so let's just link that through as well. Okay, perfect. Now we can sum this up. So let me just quickly use auto sum. Perfect. And that computes that, so which is fine, right? So we have computed that. Now let's link our current assets. So we have to link receivables net. So let's find our receivables net. Here we can link that, and also let's link inventories from the balance sheet. So we have linked inventory from the balance sheet, and now let's link prepaid expenses from the balance sheet. So here we can link that as well. Now let's come here and link accounts payable. Okay, so I think here we can just put that here we can just put that here. Okay, perfect. So we can link accounts payable. So where's accounts payable? Here we can link that through accrued liabilities. So let's link accrued liabilities. So here we can also link accrued income taxes. Accrued income taxes. Perfect. So this is great. So I think here we need to turn these figures into blue. So to do that, we highlight that. So here Alt H FC, and then M, so that we choose the blue color that we want. So here we've chosen this one, and then we need to apply it to this. So we press Alt ES, then we choose format here. So here now we just use F4, right? So F4, so which is great. And let's total this. So we can say this plus this, and then we copy that right through. Right, so we remove the cash and cash equivalents because it's not an operating asset. So here we copy that as well. And then total, we have to compute operating working capital, which is current assets minus current liabilities. So this is it. Then here we can compute, I think, changes in working capital. So we say this minus this, right? So normally that's changes in working capital, but this line is not necessary, right? So I think for now that's fine and perfect. Let's link our capex, capital expenditure. So let's go to the cash flow statement. That's where we find capex. So here we just link this. So here we have got payments for business acquisitions. We can also link that as well. And we have got payments for property and equipment. Okay. So under normal circumstances, we treat business acquisitions as capex. Okay. So we can link that as well. Let me see how I did it in the previous example. So here I think I just linked the first one, but under normal circumstances you have to also link that as well. Okay, but for now we can just change things around once the model is done. The idea is to build the model first and then make changes later. Okay, so now let's just go to the cash flow statement and link that through. Okay, like this. Perfect. So this is fine, and now we can compute the 5-year revenue growth rate. Okay, so we can come up with some assumptions. So here we are going to compute the compounded annual growth rate, which is CAGR. So to compute CAGR, we compute it like this. We take the revenue figure for 2023, we divide that revenue figure by the revenue figure for 2029, and then we say 1/5, because that's a 5-year revenue, and then we say -1. Okay, so we get 4%. Then here we compute the year-on-year revenue, So just because our revenue is starting from 2019, then we start to compute from 2020. So we take revenue for 2020, we divide it by revenue for 2019 -1, and then we copy that right through. And then here we compute the average 4-year revenue. So average 4-year revenue. So it gives us an average of 4. Right? Then we compute cost of goods sold as a percentage of revenue. So now we take this, we divide by the total revenue. Okay. And then operating expenses as a percentage of revenue. Then we divide that by revenue. Okay. And then we copy that right through. Then depreciation, we are not going to do some complex depreciation calculations, just estimating it based on revenue. Okay, so that's fine. And then the income tax rate. So the income tax rate, now we will have to use our 5-year historicals. So we come here, and then we've got provision for taxes here. So that's for 2019. Then we divide that by earnings before tax, so that we get a general understanding. Okay, so here we've got 34% and all that. So here we can just use maybe 33% or 30%. In my previous calculations, I used a 30%. So here, just for the sake of time, I'm just going to copy here everything and then just paste here. Perfect. So now we can forecast our revenue. So to forecast revenue, we're going to take revenue for 2023, since it's our base year, and then we add this revenue here. So now we copy that right through. So since all these other items are reliant on or are dependent on revenue, so we just say this multiplied by 75%. And then here it's a formula, so we can easily copy it like that. Then operating expenses, we just take 19% times the revenue that we have forecasted, and then here we just copy that right through, and then here we just take 2% multiplied by the revenue, and then we copy that right through, and it's a formula. So here we just need to remove these green irritating signs there. Okay, perfect. So we are done there, so we can compare. It's okay. Then here we just copy that right through, or let's just link that through here, because we've already projected that. And now we are on this one. So we will come back to the changes in working capital later. Let's first deal with this here. Okay, so what we are going to do is, here we are going to use the formula. We're going to take the average. So we're going to take the average of these two figures, and then we divide by total revenue. So let's just use revenue for 2020. So revenue for 2020 is this, and then we say multiplied by 365, right? And then we can copy that, and since it's a formula, we change the color to black. Okay, and then we do the same here for inventory. So we say we take the average of inventory, we divide by the cost of sales for 2020 multiplied by 365, and then we copy that right through, and then we turn that into black, and we do the same for prepaid expenses, right? We take the average, we divide by the total operating expenses for 2020 multiplied by 365, and then we turn that into black, and then we remove these irritating green things there. Okay, so we can easily compare that. So here, days prepaid, here we have gotten our 38. So it's because of here I used 365, but when I computed this I used 360. So even here, if I change to 360, you can see inventory processing days, they will be around 45. But wait a minute, let me quickly see what happened there, because it seems we are getting some different figures. So H14, so here G14, it's divided by, okay, so I think that's fine. And here we linked that H15. You know what is H15 for? So let me quickly cross check here. I'm not sure what's happening. So for 29,000, which is, that's the same that we have here. So let me quickly cross check again, because here we're still getting some 4444, which is quite different. Okay, let me quickly okay, so I think, let me start this again. So average, I'm not quite sure why average. So here we're taking this average there and this one. Okay, we divide this by total revenue for 2020, and then we multiply by 365. We still get that. So I think it's, I'm not sure why, but let's just proceed with what we are doing at the moment, because I think here prepaid expenses, because we've taken average of these two and multiplied, divided by expenses G17. So I'm not sure why the figures are changing. Let me see here. So here we've got prepaid expenses and other of 2521, but here we've got prepaid expenses and other of 1519. So I think that's the difference. Even here we've got inventories of here we've got 56. Okay, I see where the problem is. So the challenge that I did, I started linking from 2018 instead of 2019. So let me go back to the balance sheet. So you see, I was supposed to start linking from 2019. Okay, so I see where the challenge is now. Okay, so inventories, let me find inventories for 2019. Okay, perfect. Then we've got prepaid expenses, we start link from 2019. Okay, which is fine. And then accounts payable, we start to link from 2019. And accrued liabilities start to link here as well from 2019. And then accrued income taxes, we start to link here. Perfect. I think it's now making sense. Perfect. So I think here it's now making a lot of sense, because now even if we compare, it really does make sense. It really does make sense. Right. So let's now do the same here. Average. So average, then we take the average there, we divide by cost of goods sold for 2020 multiplied by 365, and then we turn that, okay, and then we change that into black, and then we do the same here, comma, say divided by accrued liabilities. These are expenses, so we divide that by here multiplied by 365, like this. Perfect. So let's remove this and let's change that into black. Now let's say average, and let's just take this, and then so here now the challenge that we are having on this one, it's because we haven't projected our income taxes. Okay, so now we will project that based on revenue. So here we project that based on revenue. Okay, and then we copy that here. Perfect. So here 0.1, which is fantastic. And now let's work on this one. So let's quickly compare that. So here we've got it's because here we use 360 and here we use 365, not much of a difference there. Okay, so here we just assume that this is going to be, let's just take, this is going to be five days, and then let's paste that, and let's assume that this is going to be 44. So this is going to be 44, and this is going to be perfect. And let's assume as well for this is going to be 42, right? And this is going to be let's say 89. So 89, and this is going to be 0.1%, and then we paste that. So now what we are doing is we take this, we divide by 365, we multiply by revenue for 2024, right? And then we copy that right through there, and we do the same here, divided by 365 multiplied by cost of sales for 2024. And then we copy that right through. We do the same here, divided by 365 multiplied by expenses. Right, so here we can easily copy that right through. We do the same here, divided by 365 multiplied by cost of sales. cost of sales, and then here we do the same, divided by 365 multiplied by expenses, and here we do the same, say this multiplied by revenue. Okay, and then we copy that right through. So even if we compare, you see there's not much of a difference to the previous. There's not much of a difference. Yeah, so basically that's it, and then we can copy that right through. So now we are in 2024, so we want to compute the changes in working capital. So say this minus this, and then we copy that right through there. Perfect. And now we project our capital expenditure. So normally capital expenditure is projected as a percentage of revenue. So to turn that into positive, we divide by, so we divide by revenue here, and we copy that right through. So now here let me copy. So we projected that revenue is going to be around 3, the projection is going to be around 3%. So this multiplied by revenue. Right, perfect. So even if we compare, it's the same. Now let's finish off on this one. Okay, so here what we are doing is we take the receivables net here minus this. Perfect. And then we copy that right through. We do the same as well for all current assets. Take this minus this, and we copy that right through. We do the same as well for this minus this, and then we copy that right through. And here we do this and this. Alright, so here we take this, we subtract this, and then we copy that right through. We take this, we subtract this, and we copy that right through. So here we just copy that. So this figure here, it is to match with this figure here. So if these figures are, let's say if this one is positive, it is to be negative here. If these were negative, they have to be positive there. So that shows that that's correct. Okay, so I think now we have finished working on this valuation model. So now we need to proceed to the discounted cash flow valuation method. So I think we can now proceed to that. So here the DCF valuation model. So now we have got the cost of the work weighted average cost of capital. So I got this from the internet, and so my sustainable growth rate, I projected it at 1%. So like I said, we have to compute the free cash flow to the firm, which is cash flow available to all to both equity and lenders, you know, that these are providers of capital. So this is the entire value of the firm, right? So here we start with, when computing the cash flow, free cash flow to the firm, we start with EBIT. So here we just link EBIT. So here I think we are starting from 2021. So we go to the valuation model, and then we link EBIT for 2021, and then we just go here, and then here we just select the tax rate for 2021. We multiply that by EBIT. Okay, so we go back to the right, so we multiply that by EBIT, which is this one. Okay, perfect. So just because this is a formula, we turn it into black. Okay, so here depreciation, we just link it. We just link depreciation from 2021 okay, so depreciation, even on this one we can still link that through. Then changes in working capital, we come to the valuation model, we look for changes in working capital here, and I think that's wrong here, so we have to go back again, 2021, so we link that through. Perfect. And then capital expenditure, we just find where capital expenditure is, so here we link that through as well, and then we sum this up, and then like this. So I think we can try to compare. Here we've got 15, 24. So here the differences are just because we used 360. There's 365. Depreciation, this is correct. And then 9271, this is correct. This is correct. So the difference are on this one. Okay. So which is fine. So we are going to tweak that so that you can see. So already we have got the 7.3%, our weighted average cost of capital. So here let's discount this. So here what we are going to do is we are going to take this, and then we say 1 plus, we anchor that, then we say to the power 1. Okay, perfect. So here we sum up this. Perfect. And then here we are on the paper, we'll start compute the terminal value here. So we take this and then we compute the terminal value. So to compute the terminal value, we say this 1 plus this, right, divided by, then we take work, then we subtract this. Perfect. And then we discount this by 1 plus the work to the power 5. So I think we can try here. So like I said, these are just minimal differences. So 178,004, it's just, you know, perfect. Right. So sometimes you may want to use the multiple method, okay, to compute the terminal value. So here we link through the exit year EBITDA, right? So the exit year EBITDA, we see it. Let me quickly come here. So here we've got EBITDA. So exit year EBITDA is this one. So we link it. Then we want to compute the 2023 EBITDA, enterprise value. So to compute enterprise value now, to compute enterprise value, we need to take the equity value, we add net debt to get to enterprise value. Okay, So that's what we want to do, right? So let's go back to the balance sheet now. Let's go to the balance sheet. So now we are on the balance sheet. Then we take the shareholders equity. This is for 2023. Okay, so 2023, we take that, and then we add this as well. Okay, and then we add this, and then we add total long-term debt. We add this, right? So I think on this one, let me just put that there. Okay, so 36, we added that, and then we move forward. Then we add short-term debt, we add this, we add this, we add this as well. Okay, and then we subtract. Then we subtract cash and cash equivalents like this, and then we divide by, if we go to the valuation model, we divide by EBITDA for 2023. Okay, like this. So it gives us 4. Okay, so now that we have that, all we need to do is we multiply the exit year by 4, right? Then we discount this, so we discount 1 plus to the power 5, and then it's 146. Okay, so here we may want to average that, so we may say average this by this, and then we get 162, 141. So we may come here, you see 162. So we may decide to use this, like here I just use Q23, which is this one that okay. So here now on enterprise value, what I will do is I'll just add, so we are just going to tweak and see how it's gonna work. So I just use that, and then total debt, right? Total debt, that's what we want there. So we go to the balance sheet, we're going to take all interest bearing debt, right? Total debt. So we start with short term, and then we go to long-term debt due within 1 year. We take this, we take this as well, then we take this, then we take this, then we take this, and we take non-controlling interest. We also take this. Okay, it's part of total debt. Okay, so we've got 68622, which is the same here. Then we link through our cash and cash equivalents for 2023. That's the balance there, right? Then we compute net debt, which is this minus this. Okay, so here we say to get there, here we subtract, then we get that. So now we are looking for the number of ordinary shares. So we go to the income statement, then let's look for the number of ordinary shares. We take the basic, and then we divide that. So here we divide this 64.04. That's the share price that we got there. Here it's just different here because of the variations that I told you about in changes in working capital. But otherwise, then we want to look for the current share price. So let me quickly go over to my phone and check what's the current share price for Walmart today. So quickly I'll do that. Okay, so here my phone is acting up a little bit. Okay, so I'm checking. So basically this is how you do. So Walmart current share price. Walmart current share price. So the current share price for Walmart as of today is 59.87, right? USD. Perfect. So this is it. So now we have to compute the potential upside. So the potential upside and then -1. Then we compute that, which is around 70%. And then here we may compute, say, this minus this divided by this. That's the margin of safety. So stands at 7% as well. The same here. So when I did this model valuation, the current share price for Walmart was around 59.85, but as of today it's around 59.87. So it presents a potential upside of 7% and margin of safety of 7%. Okay, so basically this is how you do it, guys, and yeah, basically that's it. So let's suppose here we choose we add this and then we take the average. Okay, the average here. Let's see what will happen here. So the average here, it gives us you know, it shows that like here you can see it shows that Walmart is overvalued. Okay, but if we go back to using the discounted terminal here, you will see that Walmart is undervalued. Right, is undervalued because you see the estimated equity value per share is at 64, so which means there is a potential, an upside potential. You know, the share price will in time rise to about 64, which means if you buy the share price now, then obviously you're going to profit. Okay, that's what it means. So basically this is it, guys, and I hope you've learned 1 or 2, 3 things. And yeah, I welcome your comments, your arguments, your debates. You know, I'm not perfect. This is just high level analysis. So that's it. And if you are interested to learning more about company valuation, you know, DCF valuation, please feel free to get in touch with me, and I will be able to assist you. And obviously, if you also need this valuation model templates, you can always get in touch with me. And don't forget, if you really like this video, this tutorial, don't forget to share it with your friends, with your peers. Encourage them to subscribe as well. And please don't forget to subscribe. I love you all. Have a wonderful day, and God bless you.